we're not buyers of economic weakness in a broad sense of the economy. There are obviously pockets of weakness, but in the broad sense and on the data, we just don't buy it. Not in an election year. The Democrats will do everything they can to keep spending. And to be honest with you, the Republicans, who are in a mess, particularly in the House, you wouldn't want to be that Republican responsible for a spending cut in an election year.
On this episode of the What the Finance podcast, I have the pleasure of welcoming on Nick Glinsman, who's the co-founder at Malmgren-Glinsman Partners. So, Nick, thanks so much for coming on the podcast today.
My pleasure. Good to return. I have a hobby of talking, so it's perfect.
Yeah, it works for everyone, I think, the listeners, yourself, and myself as well.
Exactly.
And yeah, I guess my first question, since you have a hobby for talking, it might be a good one to start with, keep it quite broad. What are you really currently seeing in the markets? I guess the economy, if we focus specifically on the US, because I feel like that's where everyone's currently watching at the moment.
Yeah. Well, the interesting thing, which we didn't talk about pre-show, is we've just been allocated some funds to manage by one of our clients, and to manage it in a way that they don't want us to trade daily, even within a week or so whatsoever. They want us to express our opinions on a longer term basis. And if you recall, the last time we spoke, we had been negative, the US Treasury market, from about May onwards, looking for 470 on the 10-year, 5%, and still to be hit 540, which I think is going to come. But over during this month, you had a couple of events at the beginning of the month that created a bid to the market. That was the financing announcement for the Treasury, and then the quarterly refunding announcement, where it looks like Janet Yellen, if she had her Fed hat on and did a slight twist, more bills, less coupons. The irony of that statement is less coupons doesn't mean less coupons. It means less than expected. It was still an increase. Now, there's sort of a limit to how many bills that should be the percentage in the quarterly refunding. And it's usually historically around 20%. So our expectation is we've got another two quarterly fundings that we have to be concerned about in terms of size. I would actually say the next several quarterly refundings, but we'll get into that. And she'll probably have to make up that less than expected amount on the 10-year and the 30-year. Then we had a non-farm payroll that was taken as positive. Then we had CPI that came in and people took it as positive. There were certainly markets numbers that were favorable. But what they've also done is not just create what's the yield right now? A near 60 basis points rally in a month in the 10-year, which used to take quarters. But it's also created a situation where May next year, there's a 50% probability of a rate cut. Is it May? It is May, yeah. Or is it March? Anyway, the rate cut, if you look at the short rates, I saw Deutsche Bank's new 2024 outlook today. They're calling for 175 basis points of rate cuts by the Fed next year. Like, what? People are not listening. Now, it's interesting to me. If you look at the Fed and you look at the ECB and the Bank of England, pretty much all of them with the exception of the Bank of Japan, they got transitory wrong in terms of inflation. And this was during a period of forward guidance. So their forward guidance was wrong as well. So flip that around, forward guidance disappears in a rate hiking cycle, and it should do, especially with quantitative tightening. They've got to be doubly careful about what they say, okay? And the other thing that I would stress very hard in terms of the Fed is Jerome Powell is in his second term. So this is building his legacy. He's legacy aware. He does not want to be known as the coming of Arthur Burns, who was the Fed governor prior to Volcker, right? Whereby they cut too soon and then inflation takes off again. And what's interesting about that, we're getting a few hints as to what could happen. But that to me tells me that when the Fed say higher for longer, which some people are now saying high for longer, one should listen to them. And the reason I say that is, if you look at what the governor of the Bank of England has been saying, exactly the same thing. And the chief economist joined that chorus last week. If you look at the ECB, some of the ECB members are saying the same thing. Even the less hawkish / slightly dovish Villeroy or Bank of France governor, they're sort of all intimating or expressly saying the markets are too optimistic in terms of expectations for rate cuts. Now, one thing I think most people are going to agree on is the froth in inflation was the low-hanging fruit to bring it down. It's this last mile journey to bring it down to target. And as such, they're going to need high for longer. I think last month was possibly the low of CPI, because one of the things that you're going to see is every year from October to September, they have to adjust for health insurance costs. So we've just gone through the first one of that. Health insurance costs were up 1.1%, but that left them down 34% for the year in the US. You talk to anybody, health insurance costs are not down, they're up a lot. And they've done it according to a moving average, and there's a connect with the health insurance company profits. Who knows why they do that? But the anticipation is that moving averages, when they turn, then you're up on the, and we've just turned. Then we're going to have a steeper gradient. So that the next ones should be bigger. It's interesting today, given that we've just gone through Thanksgiving and Black Friday, now we've got Cyber Monday. Don't know what there is for Tuesday. But Cyber Monday reports, people were suggesting were not that great. Adobe said they were up over 7%, the sales. MasterCard said they were up over 2.5%, I believe it was. This is up. The consumer's still out there shopping. Those people who are lucky enough to have houses, they're not feeling bad. Those people lucky enough to have equity portfolios or 401ks, they're all feeling pretty prosperous. And the interesting thing that people conflate, and I think forget, is if you look at the monetary transmission mechanism for the US, and then you look at it for Europe or the UK, but let's take Europe. And why is there such a difference in economic performance? Well, in the US, 75% of loans are fixed rate. So that transmission is slowed right down. In Europe, it's flipped. 75% is floating rate, rapid transmission mechanism. Now, the other thing about the US, which I find interesting, that people have forgotten, is actually it's not a really internationalized economy. The currency is being the reserve currency, but it's not dependent on international. It's quite a contained economy. Whereas in Europe, Germany is incredibly dependent on China. UK suffered somewhat because of Brexit, but there again, they're building up some of their other trade agreements. I mean, the TPP agreement for the UK is amazing, and actually could be a backdoor into the US. But that's something we could discuss on a future video. So the point I'm making is, we're in a situation now where the discounting measure at the short end for what the Fed's going to do next year is assuming perfection. We didn't get perfection. And actually, last Thursday, the jobless claims number suddenly went back down by quite a bit and surprised the market. Now, that had a day or two of repercussions in the treasury market, and it's all been forgotten again. But it just strikes me, November, December data is not the data where you buy for perfection on the treasury market. So in terms of what are we doing in the positioning now that we've got institutional skin in the game, we're fading the treasury rally literally at today's levels. So on the 10-year, we're at 440. So we're fading that. Maybe it goes to 435, that's fine. Because we're looking for a move back into the 450 to 5% range. And one of the reasons we're looking for that is we don't think the Fed's going to be as aggressive as the market's discounting by a long measure. And we're concerned that a lot of the market, the conventional wisdom is there's going to be a fiscal contraction in the States. In an election year? In an election year? No way, right? And the other aspect of the deficit side that's really important, and it's actually good to see Bank of America have come out and agreed with us today, a piece of research today. Mark Cabana, who's their rate specialist, who is actually very, very good. I don't listen or take notes of many people on the sell side. He's one person I like to keep on top of in terms of what's he saying. We wrote a white paper for some clients in May, April, May. There were two papers. And it basically we were saying that the defense aspect of spending historically always gets underestimated. Okay, we've already got the Wharton Business School model telling you that the Inflation Reduction Act is running at 3 times what the CBO estimates. Well, again, on the defense spending side, because the commitments the US is making, sending an aircraft carrier fleet to the East Mediterranean is very expensive. You've got 2 there. You've also got 1 down at the Red Sea. You also have at least 1, if not more, nuclear submarines floating around undetected. Those are expensive, really expensive commitments. And in fact, I would contend that the current situation in the Middle East, Iran's proxies, i.e. Iran, is trying to stir up the US forces into a full engagement. Apparently today there was an attack on a US vessel by the Houthis. And it's the Houthis in Yemen that have been firing the ballistic missiles into Israel. So there's more commitment. But let's not just stop at that. You had the commitment in the Ukraine, which will require a rebuild of ammunition stock. Expensive. Then you go to the Far East. Let's take just one example of many. You have the Philippines, obviously connected to the US historically, where the US has said, we will upgrade 3 military bases and build 2 more. Again, a very heavy commitment. Why are they doing that? Because Philippine vessels are literally being pushed around by Chinese Coast Guard, stopping them getting to one of those shoal islands that's well within the 12-mile economic zone of the Philippines. So that's built. So all these commitments will just create a greater burden on the US deficit. So we don't look at it as coming down. We think it's on a path quite significantly higher. And if you go back in history and look at the Cold War expense, I think it was 5.7% of GDP. So, now, the other area that we think will preclude weakness in the US economy in an election year is the TGA account, wherein Janet Yellen basically has 3 credit cards that she can spend to boost the economy or boost the conditions that will boost the economy. She's done it already once. Now that TGA account is being replenished back up to around 750 million. One would expect her to do it again quarters 1 and 2 next year. Thus, the feed through will come through in quarter 3, running into the election in November. So we just don't, we're not buyers of economic weakness in a broad sense of the economy. There are obviously pockets of weakness, but in the broad sense and on the data, we just don't buy it. Not in an election year. The Democrats will do everything they can to keep spending. And to be honest with you, the Republicans, who are in a mess, particularly in the House, you wouldn't want to be that Republican responsible for a spending cut in an election year, unless your seat's not up. But even if your seat's not up, you're going to have some colleagues that will be pretty upset with you. So we think the economy, I saw a new update to economic growth forecast by Goldman, which was at 1.9% for this quarter. Still pretty bloody good. It's not a soft landing. It's not a recession. Now, if we're wrong about the economic strength and we go into recession, two things about that precludes the bond market doing better at the long end, not the short end, the long end where the inflation comes through. One is all the automatic safeguards in a recession will kick in, welfare, so on and so forth. And two, inflation won't have got down to 2% target. So you could be in a bit of a stagflationary situation, which by definition is what Europe and the UK are in. UK less so than Europe, but Europe is, if they hit negative growth, they've still got inflation too high. That's not good for the long end of the bond market. So that's why we're happy to fade. And that's a position that will run for a while. If it goes against us, we've got a level where, okay, that's not working right now, but we think it's sensible. And I think there's one other aspect that we want to consider. The US economy is incredibly financialized. So the higher the stock market goes, better sentiment for the economy. And you can actually do a correlation on tech industry employment and the stock market. So January, when we'd had a bad November, December, lots of layoffs in the tech industry. A couple of months later, they're hiring them all back again, right? So it's a tug of war. And if you look at the financial conditions index, I tend to look at Goldman Sachs. We're no longer, we're at the average for the year. And that was never considered tight enough by the Fed because they carried on, when we're at those levels, they carried on raising rates. So I think we're going to see some of the Fed messaging come out and say, well, if you think we're cutting rates next year as aggressively as you've priced in, think again. And our intent at saying, well, look at maybe the market, the treasury market will do the tightening for us. But it's gone. So think again. And finally, in the background, there's quantitative tightening. Just keeps getting boop, 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 boop. 60 billion every month. So I think from that perspective, we're fading the market, looking for higher yields from here. And that will feed through to other assets, particularly the risky space. Especially if there's a recession, obviously. I don't see equities doing that well in a recession. They have to adjust. But there again, equities do live in the nominal world, whereas bond traders and geeks, which is the world I live in, we tend to live in the real world. Real as in inflation adjusted. So that's where we're on the rates market. We're looking to fade it. We don't think the Fed cuts as aggressively. We think, never lose sight of the fact that Jerome Powell does not want to be Arthur Burns, and thus remembered for making the same mistakes. So that's our summary. So it's not as rosy an outlook as the way the markets are behaving right now. Hopefully that was clear.
Yeah, no, thank you so much for that explanation. I appreciate it. I guess if I maybe push back on that a little bit, as you said, that you think there's going to be lots of fiscal stimulus coming through, especially next year. You mentioned the reasons why. But I guess the US economy, most of it's based on, the consumer and consumption in that regard. So is there a risk that I guess everyone's been quite surprised how strong they have the consumer has been over the past 2 years? Is
They're
there a risk
always
that,
surprised. Everybody,
yeah,
people are. It's the same. You're sitting in the UK. It's the same there. People are always surprised by the ability of the consumer to spend money, regardless of other data where oh God, the consumer's going to get hit. It's the US in particular is quite a sticky consumer, and even with the discounting and pricing that went on over Black Friday, it was hoovered up. Now, the other thing, by the way, on Black Friday, I read an article in the Journal today. Consumer companies' inventories have come right down, and we're running into Christmas. What does that mean? Inventories have to go up. Now, they'll probably manage it in a lot better fashion than they did with the COVID reopening, where they boomed the inventories that they could get hold of and took it. But that's another positive for the economic cycle. So I mean, ultimately, I'm an optimist, but actually, I guess I'm giving quite an optimistic view of the economy, to be honest with you. I just don't. I don't believe in perfection, and the markets are pricing perfection. A soft landing. Fed starts cutting aggressively. I don't know why the Fed would cut on a soft landing. The Fed would cut on a recession. So it just strikes me that the market's well ahead of itself right now.
okay.
And the other interesting thing, if we take the bond market and we take one little snapshot of that, people have been buying the bond market. Pension funds, insurance companies, retail have been buying the bond market all the way down in price. All the way down. You can see that if you take the note ETF, TLT, as that came all the way down in price, shares outstanding were on a parabolic rise. So it tells you people kept buying, kept buying, kept buying. What that does, given that that's particularly a retail product, is at a certain point on that retracement back up, people sell because they've made, they will crack out, it's underwater. Let me sell what I made money on and keep the rest and hope it keeps going up. So people say, well, the market's not long. The market's long. People have been buying. I spoke to a couple of pension funds in both the US and the UK. And 4%, they said, well, it's got value. 4.5%, it's got value. Now, pension funds, what is their job? Their job is to provide retirees with a inflation-adjusted return so that they can carry on living their lives. Some of these pension funds have lost 20, 30%, but they beat the index. So what, right? That will come home to roost at some point. Yeah, and they still get, obviously they still get money in because they're on various schemes, but the market's not short treasuries, the market's long treasuries. Right? Just people have kept buying, kept buying. The one area of the treasury market that we own, and I own personally, is the 10-year TIPS, the inflation adjusted, which I bought at 250, and that is currently trading at a yield of 219. So that's worked out well, but at 250, you just keep it. Why not? That's a great pension plan, actually. So that's the view on what worries us, what we're looking at in the US economy, and why we fade the US Treasury market right now.
Okay, no, that makes sense. So it sounds like the only way this wouldn't go your way is if there's sort of a regular recession, or even sort of what we saw in 2008, where everything goes to hell and everyone goes onto these risk-off assets.
Yeah, if everything goes to hell, absolutely. And actually, I was having an interesting discussion last week. So if everything goes to hell, well, actually, it was a discussion on Bitcoin and gold. okay, which everybody says, well, those are insurance in case everything. But if everything goes to hell, you're probably going to need Bitcoin, gold, and guns, right? And great big stock of tinned food or whatever. So in that respect, this is just an interesting extreme macro view or macro rationale behind Bitcoin and gold. In that respect, what is everything going to hell mean? I don't think it's the GFC, where it was Lehman bust, everything else was saved. I think it's an extension of or equivalent of an extension of the sovereign debt crisis in Europe, where Mario Draghi came out and said, do it, we'll do everything we need to do, effectively, paraphrase what he said. Whatever we need to do, okay? Now, had that not happened, and one or a couple of countries had to default and leave the euro, that wasn't the thing that would create the crisis where Bitcoin and gold have their insurance value. It would have been the fact that parts of the banking system would have gone bust. And when that happens, and we're talking countrywide banking systems, when that happens, then that feeds through to the better. The bad would feed through to the better. That's an environment where I could see Bitcoin and gold skyrocketing. But we just hope we don't get there. I mean, interestingly enough, if we go back to the regional bank, it wasn't even a crisis, but SVB and the other two banks that went bust. You're in the right country for this. So I didn't consider that big enough to be a crisis. I think part of the fault on why they were in trouble was a lack of communication by the Federal Reserve as to its intent to raise rates aggressively. And the Fed, as lender of last resort, as well as the FDIC, can tell the banks, listen, one, you better start paying interest on deposits, otherwise you're going to lose your deposit money. Two, we're on a policy of tightening. Be aware of that given your portfolios. However, what happened with, we wrote a piece as that was going on, and it was the resolution of it was almost identical to what happened in the 70s in the UK, which was called the Lifeboat by the Bank of England, where it started as some smaller banks got into trouble related to some property companies, real estate companies that got into trouble. And the bank went to the big banks, Bank of England, and said, we need to create a pool where we can rescue the assets related to the banks. And it ended up with the Bank of England actually being the major player in that pool, obviously. But that lasted a year and a half. What happened in the States lasted less. And, well, what about the commercial real estate market? The world's still carrying on. We've seen prices come off. Is there a crisis? There's only a crisis when there's so many forced sellers of commercial real estate. And there's been forced selling, but it ain't crisis levels. And of course, it's very focused in the office space. Now, the office space was always going to suffer because of the structural change post-COVID with work from home. I presume you're working from home?
Yeah, don't have to go in as many as I.
We'll see. Although I do miss an office. I mean, the old office in Baker Street, I loved it. Anyway, that's beside the point. But not all commercial real estate was in trouble. There was an area of commercial real estate where you could not get enough exposure on the upside. Factories, building factories, because of the reshoring and de-risking from China, which despite the kiss and make up of Xi and Biden in San Francisco, is still carrying on. And the reason it's still carrying on is people say it's the US and the West that's decoupling and de-risking from China. It's the other way around. And the reason why it's the other way around is really the Chinese have set up laws and tighten the system around the Communist Party so that even if you're a foreign company, whatever data you have in China has to be exposed to the government, and that company's local board has to have a CCP representative. It sort of reminds you of Judy Christie's friend in Dr. Zhivago, who was comrade, I can't remember his name, but the Red Book and everything. Anyway, so they're making, and then you have the espionage laws where you can't go and do any research. So they've pushed away quite a few really large investors there. Couple of the Canadian pension funds, Vanguard, shut offices. Management consultants can't go and do their due diligence for clients. So they're pushing it away. Thus, that reshoring effort has intensified, not only because of that. Take Germany, which we view is on a path to deindustrialization, slow path. A lot of their businesses need guaranteed energy. One. Secondly, a lot of their businesses have decided we need to be closer to our client base. So the German auto companies, for example, are shifting production that's intended for the US and the Americas generally to the southern states. So factory commercial real estate, think of the chip companies, is boomtown. Okay, and that's actually, if you want proof that this is actually occurring, Mexico is a great example. Mexico now exports more to the US and China, and the Mexican peso has been steadily performing better and better because of that very reason. So there's some really interesting stuff going on, but if I look at the conventional wisdom in various buckets of the US, buckets anywhere, you can always, if you can rationalize the weaknesses of the conventional wisdom, and we tend to do it by, Harold was chair of Cornell for economics. My background was economics from the LSE. We tend to use a lot of behavioral economics where it makes sense that these processes are going to have a feed-through impact. And that's the way we got it. That's how we called, we went, it's rallied for this month as well, the offshore renminbi, Chinese currency. But, back in April, we said, China's uninvestable. Well, stock market's been terrible. And you've got to be long dollar against the offshore renminbi. And it was at 670 and we got up to 730 plus. We're at 716. I don't see that changing that much though. Yes, there's a push by Xi after that kiss and make-up meeting with Biden for more exports. But the trouble with China is following the path of Japan, the middle-income economy. It's Japanification, redux to Chinese style. And the reason I say that is, I feel there's an argument to suggest that the economy's had a balance sheet recession, which is going to take a long time. But the households, the consumers, have been destroyed by what's gone on with the real estate market. It's simple, logical conclusion and a great example of behavioral economics at work. So everybody got very excited about China reopening after COVID. Hold on a second. We've just seen a complete meltdown in the real estate market. If you're the Chinese consumer, I'm not talking the billionaires that we see who are all slowly being put in jail or disappearing. If you're the median Chinese consumer, you will have one house. You may have bought a second house or apartment to rent out. You've just suffered between, well, let's take a round number, 40% hit to your balance sheet. That real estate was your savings. Are you going to consume more because the economy is weaker? No. It's the flip side to what's going on in the US. Okay? It's absolutely the flip side. So it's an interesting dilemma. Now, let's progress to an area that will cause more trouble for the US and global bond markets and global assets. I was having a chat. I was on a discussion on another podcast where I said the world's biggest carry trade is the Japanese government. If you combine the balance sheets of Bank of Japan, Postbank, and the GPIF, which is the government pension fund, it's $20 trillion in size. It's 500% of Japan's GDP. Okay, now why? Obviously, not all of that's an offshore carry trade, but there's been a carry trade domestically as well. Now, why am I talking about that? Well, they have a big footprint in foreign assets. Even the Bank of Japan bought domestic equities, but Postbank, GPIF would have bought international equities, no doubt US tech. Swiss National Bank, Central Bank of Switzerland, they bought US tech. So the interesting aspect of that is really the Bank of Japan are getting rid of yield curve control. Okay, that impacts the long end, 10 years out. But there is also an intent to get rid of negative rates, driven by inflation. Now, we had a PPI out today that was nicely above expectations and counters the narrative from the Bank of Japan that consumer price index could actually decelerate somewhat, still over 2% now. Now, if you suddenly had zero rates or positive rates in Japan, already the foreign exchange hedge doesn't work for you if you're buying US Treasuries hedged back into yen. But if you go from negative to zero, what happens to the yen itself? Now, with that offshore carry trade, it doesn't matter really what happens to bond price because they've made so much money on the dollar yen or euro yen. I mean, they've made huge amounts on that. What if the yen starts to rally significantly? Okay, you know that Japan owns 9% of the French government bond markets. Japanese are huge players of the Brazilian government bond market, and they're still one of the big foreign buyers of US Treasuries. Be the same across the board elsewhere. What if that demand goes? That is another negative for the Treasury market. So, our view is, and we sort of have some people that we talk to high up. Harold's got some wonderful contacts in Japan. The view is yield curve control goes Q1, negative interest rates goes Q2. Well, that will upset the apple cart when it comes to foreign assets, particularly bond markets. So there's a combination of stuff that you got to be watching carefully. So every time I see an inflation figure in Japan that's higher than expected, I'm building the Jenga pile. Okay, that's another one. That's another one. And they're all interconnected. I can say that safely. If you remember the UK, the Liz Truss budgets, and what happened to the gilt market, that fed over to the European bond market, but it also fed to the Treasury market. So that interconnectedness is critical in terms of the rates market, and it's critical in terms of other assets. As much as equities tend to walk to their own drumbeat, if you have certain upsets in the rates markets, they take notice in the end. So there is an international aspect to our domestic view as well. I sound gloomy, don't I?
No, it's really good how you explain that all, because I think I talked to someone called Weston Nakamura who has quite a good insight in Japanese bonds, and he was saying the exact same thing, that the impact they have on on basically the globe because of how much investors they are globally.
Well, I mean, people talk about Mrs. Watanabe, the retail investor, and they're big. They have a big impact, but this government balance sheet is huge.
Yeah, definitely. And another point you mentioned there, I think it was a few minutes ago, you were talking about onshore or reshoring or nearshoring or onshoring, and then the AI boom. And I think that's another one-off aspect of this investment that's going to occur in the US and other markets, which was actually probably going to keep economic growth stronger than everyone is expecting. Even if it's just for the next few years, it's going to be that boom that's going to continue it.
That's why I remain an optimist. We can do so much with it. We've got um, a soon-to-be colleague, given that she's just given birth, who is all over AI. And some of the stuff she showed us that she can do relating to the work we do, like, oh my God, it's fantastic. Oh, that's a lot less work, in terms of our written work. So it's very interesting, and I agree. That's why I'm optimistic. But that doesn't necessarily have to make me optimistic all aspects of the financial markets. Also, the other thing I can see happening, if we are looking at rate cuts in the future, is I can see Europe cutting before the US, if the US were to cut at all. Okay, so what's going on with the euro? Because I can't see the European stock markets, the Euro stocks, outperforming the S&P. So there's some conundrum there, to use one of Alan Greenspan's favorite words, the conundrum. There is conundrum there that I think we have to be aware of.
Yeah, it's a great point. So, Nick, thanks so much for your time today. I really appreciate it.
My pleasure.
I've really enjoyed how you've sort of linked it all together, and it's a really good thesis. I guess we'll
Good.
see what happens in the next year or so. But my last question is, what is one message you want people to take away from the conversation?
Question what you read, and question if you're running your own money, just keep posing questions as opposed to just go with the flow, because you could be the last at the end of that flow. Okay, so that's one thing that I think you have to just be cognizant of. I mean, we're always questioning it. You've got to be, if you do it as a professional job. Somebody said to me, so what's the main characteristic of a portfolio manager? And I said, well, the main characteristic of the really good ones is neurotically calm. Make the assumption that there's a banana skin around every street corner and it's waiting for you. So how best do you avoid that? So that's how I would define it. Just be neurotically calm. Always question some of the assumptions. And if you see everybody saying the same thing, that's where the question should get louder.
Yeah, great point. So thanks again for coming on. I appreciate it.
My pleasure.
If anyone wanted to find out more about your work and what you do, where would the best places for that be?
Well, you can find me on Twitter at @nglinsman. Or we don't have a website. We have a Shopify site, Malmgren-Glinsman Partners. If you search on Shopify, you can always message us through there. We have a message function, so we get those as well. And please message us. We typically respond pretty quickly.
Perfect. I'm sure I'll be able to find that and put in the description. So thanks again for your time.
Terrific. Thank you.
Thank you so much for listening, and if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.